Hey everyone, welcome back to the channel, the investing channel that primarily focuses on income-oriented investing on the Canadian and the US stock market, designed to provide you with passive income every single month. So Harvest ETFs is one of Canada's biggest income-oriented fund managers, and they have a really nice lineup, like we all know, of covered call ETFs, but they primarily have ETFs that really focus on the big blue chip US companies until now. So they just came out, or they just listed a brand new covered call ETF called the Harvest Canadian Equity Income Leaders ETF, which focuses on some of the best dividend companies in Canada, and of course uses every income investor's favorite income enhancing technique, covered calls. So this ETF is actually very comparable to BMO's ZWC ETF. That is by far the biggest diversified Canadian focused covered call ETF. So in this video, I will review this brand new ETF in detail, and I'll also be speaking to the CEO of Harvest, Michael Kovacs. So Michael Kovacs is back on the channel. Very happy to have him back. So should you invest in this ETF? How is it different from ZWC? Will this ETF be added to Harvest's all-in-one covered call ETF, HDIF? And what if Harvest goes bankrupt or gets bought out? What happens to all your money if you invest in Harvest products? Let's find out together. All right, everyone, as usual, when we want to find information on a brand new ETF, we go to the fund manager's website. So we're lucky that Harvest has a really nice website. They recently revamped it. So this is HLIF, the Harvest Canadian Equity Income Leaders ETF, steady income from Canadian leaders. So what they say here in their little introduction, Canada is home to some of the most dominant companies in the world in industries like banking, telecom, energy, utilities, where a few key players have basically the big market share, right? Long history of dividend payments. So if we scroll down, we'll see some initial key facts here. So we're looking at 30 stocks total. Obviously, this is in Canadian dollars. The distributions are going to be monthly, just like Harvest's other covered call ETFs. And we actually have the first distribution amount and the first record date. So the first dividend is going to be paid out sometime in August, and the first dividend will be declared at the end of July. So the initial yield is targeted to be 7%, but right now, based on this NAV here, which is as of July 6th, so I'm filming this on the 7th, so it's always one day behind, it's normal, you're looking at about 7.5%. So how do I figure that out? Well, you just do 0.0583. That is the monthly dividend. You want to do times 12 for the annual. It's about 0.7, 0.6996. So 0.7 divided by 925. And times 100, always times 100, and you'll have 7.56% yield. So really nice yield, over just under 8%, which is really good. So what is the objective of this ETF? So it seeks to provide unit holders, that's us, with monthly cash distributions, the opportunity for capital appreciation. So always keep in mind, when you see whatever you see first, that is the main objective of the ETF. So if you see distributions or income, or sometimes it's called current income first before the capital appreciation, you know that it's primarily an income-oriented fund. And lower overall volatility, that's of course what the covered calls. And to achieve lower volatility, the Harvest, this ETF will generally write covered call options on up to 33% of the portfolio. So that is Harvest's covered call strategy. They never go past 33%. Doesn't mean they will do up to 33%. Sometimes it's lower. Sometimes it's, it could be close to 33, but not more than 33%. So 66% of the portfolio will be capturing that upside if the stocks go up. So equal weight. So 30 stocks, so approximately equal weight, 30 diversified Canadian equities, companies that meet stringent dividend criteria. So obviously these are going to be companies who have strong dividends and tend to grow their dividends over time. Large cap leaders, that's typical with Harvest, only the big guys. Dominant dividend payers. Attractive monthly income covered call strategy. So let's look at the ETF facts here. You have the management fee of 0.65, so the same thing as ZWC, and we'll compare it with ZWC in a quick second here. So let's check out the most important thing when you're looking at an ETF. What is inside the ETF? So here is the breakdown. Financials, typical Canadian breakdown, right? Heavy on the financials, utility, energy, and telecom. That's the biggest dominant sectors in Canada. So you have your typical Canadian sector allocation here with 3.4% in real estate, which I find is really, really cool because there is no real estate. As last time I checked, we'll check it out in a second, in ZWC. So very heavy on the utilities and telecom. So telecom could be, factored in or be included in the utilities umbrella overall. So we're looking over 30% utilities, everyone. Very defensive. Big chunk in financials, of course. It's going to be mostly the big six banks and insurance companies. Energy, we'll check out what's in there, and a little bit of consumer materials as well. So all in Canada, everyone. This is purely Canadian. Let's check out the stocks one by one together. So I sorted by sector here. So communication services, what are the three that you'll always see that are the big three, right? Bell, Telus, Rogers, not a surprise. Consumer discretionary, you have Restaurant Brands International, which is cool, and Canadian Tire Corporation, probably one of the biggest consumer discretionary stocks in Canada. Energy, you have the big five, the five that you always want to see, the big three pipelines and the two big oil and gas producers. So obviously Enbridge, TRP, Pembina Pipeline, number one, number two, number three, the biggest pipeline. So these are, I consider these three defensive because they're more, utilities, they're more pipelines umbrella than energy. But then you also have the two biggest oil and gas producers that you always want, Suncor and Canadian Natural Resources. So these two are really energy, and these three, although they're under the energy umbrella, I consider them more along the lines of pipelines. Financials now, of course, you have the biggest chunk in financials, and there are zero surprises here. You have Manulife, Sun Life, Great-West Life, the top three life insurance companies, and of course you have all the big banks. Power Corporation of Canada is also here. So Power Corp of Canada owns IGM, which is Investors Group. So Investors Group is here. Power Corporation owns Investors Group, and they also have a big stake, or the biggest stake, in Great-West Life. So these are really dividend aristocrats, and they tend to raise their dividends over time. You have some materials, which are gold producers. The two, obviously Barrick is probably the biggest one in Canada, I believe. And you have this one here as well. You have one REIT, the Choice Properties REIT, which is a really blue chip big REIT in Canada. And of course, here are your utilities, all the ones you want to see. And you should know all these stocks by heart, everyone. If you're a Canadian investor that knows dividend companies, you'll know that it's always the same ones that come, and there's a big chunk in utilities, very defensive. So obviously you have Hydro One, Brookfield Renewable, Canadian Utilities, Emera, Fortis, Algonquin. Those are, pretty much the biggest ones. So in terms of breakdown, there you have it, typical Canadian breakdown, sector allocation here. How does it compare with ZWC? Probably it's going to be its biggest competitor, a behemoth fund that is almost at 1.5 billion. So what are the differences? Well, that's definitely one difference. ZWC is probably going to be always bigger, but you never know. Time will tell. And the first difference I see is the yield. So the HLIF yield is going to be a bit higher. It's going to be about 0.5 to 1% higher, if it starts at this distribution rate, which Harvest is known for, very, very consistent and steady dividend. So you're looking at a little bit higher yield, which is always nice. The management fee is the same, but if we look at the holdings, and this is where you see a little difference here. Here it is. Here's the breakdown. So ZWC is almost 40% financial, so very heavy on the financials, whereas HLIF is a bit lower at 35.5. 16% energy, 16% energy. I think they literally have the same energy companies, but the difference is really the defensive. There's more utilities and telecom. So if you combine utilities and telecom, you're looking at about 31%. And if we combine the utilities and telecom of ZWC, you're looking at about under 20%. So very, very a more defensive mix here. So I kind of like it. A little bit higher yield, a little bit more defense with the REIT in here. I kind of like it. But of course, ZWC has a lot of the same stocks. So let's, keep in mind that they're still very, very, very comparable. So that is HLIF in a nutshell, everyone. So, great Canadian companies, the ones you want to see. Obviously, they're focusing on dividend growers, or else they wouldn't put something like, like this. Companies must meet stringent dividend criteria. And of course, they have documents, why invest. They always have nice brochures. You could check it out. But this is HLIF in a nutshell. So now let's talk with Michael Kovacs and hear it from the CEO himself. Let's talk all about HLIF and find out more about it, as well as more about Harvest as well. All right, I am joined once again by Michael Kovacs, CEO of Harvest ETFs. Thanks so much for joining us once again, Michael, on the channel. How's it going?
Thank you for having us. Oh, it's going very well. I mean, we all know what the markets have they've been like. They've been very tough and challenging, but all in all, we're plugging away. Things are going well. So, we appreciate being
Excellent.
here.
That's why I love covered call ETF. So we'll talk about your new covered call ETF. Always exciting when there's a new Canadian listed covered call ETF. If there's ever a new one, I got to know about it. That's my channel's bread and butter. So, of course, we're going to be talking about HLIF,
Mhm.
HLIF. That is your new Canadian focused covered call ETF. So, tell me the thought process behind the creation of HLIF, as this is your first Canadian focused covered call ETF in your lineup.
Right. Well, as you know, we've have a number of covered call ETFs in the European and U.S. stock market, if you will, the larger cap, bigger markets. And this was our first entry into the Canadian market. We felt it was time to sort of fill that hole, if you will, and bring out a Canadian product that could focus on the larger cap Canadian names, set up an option strategy that would allow us to generate that additional income. So it was an opportunity to bring that product out. It would have been great to have better markets, but sometimes down markets are the best time to launch products. It seems counterintuitive at the time, but it usually, in the longer run, usually is.
Yeah, well, this is a covered call product,
Correct.
which is a very defensive product. So I actually think it's a great time to launch them during in a market or in a situation where people really want that stability, that defense, and that consistency. So this is Harvest's first pure Canadian focused covered call ETFs.
Mhm.
Everything else in your lineup is more US focused. So was there a strategic decision why you waited until now to launch the Canadian product?
Not really. We just like as I mentioned, we had a sort of a gap in our product line that we wanted to fill. Plus, the Canadian market it's not as deep as the U.S. markets and the European markets. And Canada, whether it's through mutual funds or previous products, has always had a lot of Canadian products out there. So we thought initially when we launched the company and started focusing on ETFs, we really wanted to focus on the bigger, deeper markets, and then eventually come back to the Canadian market. As you know, or we have a couple of Canadian mutual funds that we launched way back in 2009, 2010 when we launched the company. But so we are in the space, but this was our first launch, if you will, into the ETF space, focused on the Canadian market and generating that additional income.
Okay. Yeah, it's true. You do have two mutual funds. I keep forgetting, always
Yeah, no one
always
talks
think.
about those.
Yeah, that's true. The ETFs are getting much more popular now.
Right.
So in terms of the space, the covered call ETF space on the TSX, in terms of diversified covered call ETFs, focusing on Canada, ZWC from BMO or
Mhm.
ZWC, I keep saying Z because I'm Canadian, it is basically the biggest one. It has over $1 billion in assets. This is probably very, it has a lot of the same holdings that HLIF does. So
Mhm.
in a nutshell, why would an investor choose HLIF over ZWC from BMO? Tough question, but I'm sure
Well,
you could answer.
there are some differences which I'll talk about. But first of all, Vivo's done a great job in the ETF market in Canada. They were probably one of the first to offer on a retail basis products up to the Canadian market. But we just felt, as I said before, we had an opportunity to launch the fund. It's a little bit different. We're actually 30 holdings, which is about 25% less than I believe they're 40 or so in their portfolio.
Yeah, they're at
Um,
35.
they're at 35. Okay, yeah, I knew it was somewhere in that range. So we have a
Yeah.
few less holdings. We have some holdings that are our concentrations are higher, like in financials. In some areas, they're lower. But generally, it's another alternative in the Canadian market. The structuring of the cost is pretty much the same, but we have a higher yield. So there are some differences there. And why not have another opportunity in Canada to look at another product? So it's up to the investor in the end what they feel more comfortable with. But we think we put out a pretty good product for Canadians.
Yeah, I like it. I mean, the management fee is the same, and it look a lot of the same holdings. But I did notice, like you said, a bit less holdings. And one of the biggest differences I see is that there's a bit less in financials compared to
Mhm.
ZWC, and a bit more in utilities. So a little bit more defensive, which I personally like. There's a nice chunk in utilities and telecom, or that utilities umbrella. So what was the decision behind this? I'm assuming you guys are very, very pro, or you really like that defensive sector in utilities, Canada.
Well, defense, you're right with regards to defense, but also in Canada, unlike the US markets, you have a lot fewer stocks that meet that criteria: large cap, dividend paying, um, strong management teams,
True.
consistent
Yeah.
track records. I mean, a lot of focus in the Canadian market is on the TSX 60, as you know. So, and those are your sort of top 60 companies. So it really came down to where we saw more value, where we felt we could do better for our clients. So that mix, as I mentioned, is 30 stocks. There's a little bit more in utilities, a little bit less in financials, but the differences are, I think we're across 7 sectors as well, and I think BMO is across 8 sectors if we're comparing there. So there are some fine tuning and some differences, but at the end of the day, it's where did we find value as a manager? Where did we feel most comfortable investing at this point?
Yeah, there's also a REIT in there, which I kind of like.
Yes.
There's no real estate whatsoever in the BMO one. So yeah, like you said, different, similar but different. So everyone has to make their choice. A little bit higher yield as well. It looks like it's going to be 0.5 to 1% higher yield as well. So are we sticking? Is the harvest covered call strategy is up to 33%. More of a dynamic covered call strategy, whereas BMO it's more, it's set in stone, 50% out of the money. So is this going to be the case for HLIF as well?
It will be. It's definitely more dynamic. It's definitely a decision made by the investment management team every month when they look at what kind of yield we need to require. We require on the option side to shore up the dividends, if you will, to generate that cash flow. So it's not sort of set in stone every month. But the Canadian option market is a little tighter, a little more challenging, if you will, than the U.S. market. It's not as deep, so there's a little more work with the brokers out there, which are mainly the big banks, to set up an option portfolio. But we won't just sort of hit the enter button every month and write 33%. So some months it could be 22, some months it could be 31. It really depends on where the markets are. If we want to let the portfolio run a little bit more, and then if things get a little overvalued, we write more at that time. The idea is to generate over the year that level of cash flow.
Yeah, that's great. And I recently, I was a special guest host on the ETF Insights, which
Right.
BMO hosts, and we had an options expert. He actually works at the Montreal Exchange where the options are done, Richard Ho.
Mhm.
And this is maybe a question I could ask you because you guys do these options every month, all the time. So, do you feel like the Canadian options market? I know it's much smaller and, like you mentioned, a lot harder to do the options and compared to the U.S. market. Do you feel that it's maturing? In Canada, the options market? Do you feel like it's gaining momentum and it's getting more liquid and all that kind of stuff?
Well, personally, I don't think it is. I think it's been sort of stuck in a rut for the last 25 years. I don't see
Really? Okay.
yeah, I don't see a lot of new players showing up there. It's still fairly tight. The bid offers move around quite a bit when you're sort of trying to step into it. So it may be more liquid than it was 10 years ago or 20 years ago, but you're still
Mhm.
not seeing a lot of, say, US players come into the Canadian market to play those stocks. They'd rather just buy the US options. So it's still fairly tight. And it
Okay.
still requires a lot of sort of work to put together that option strategy, if you will, and put it out there each month.
Okay, sounds fair. Thanks for that info. That's an honest. That's a great information to know. So hopefully it matures, and we know
Yeah.
the US one is. I mean, options are crazy there. It's really liquid and very popular. So hopefully that comes to Canada. I guess it'll take some time. So going back to the cover call ETF, so HDIF with an F
Mhm.
is an all-in-one, very popular in your lineup now. Very successful. I mean, it's just a few months. It already passed 100 million. So congrats on that.
Thank
And
you.
that covered call ETF has 25% leverage and has five of your harvest ETFs on an equal weighted basis. So really cool. Is there any plans? So considering it's an all-in-one to maybe put this new Canadian focused one inside of it, or anything like that? Any plans along those lines?
Well, it's always been sort of the longer term plan. We wanted to get HLIF launched. We want to get through the seed capital. We want to see it trading successfully in the market. And now we've got to that point. So it is, let's say, eligible now to be entered into HDIF. What the timing is on that, it could be sooner than we think. But until it actually happens, we can't really talk about it too much. But it is.
I understand.
I'm not sure when this video is going to come out, but we could see that happen relatively shortly. But to
Okay.
answer your question, it is an eligible product for HDIF, and it's will certainly add a little more Canadian diversification to that fund at the time.
Yeah, and we kind of touched base in the last Q&A that we did about HDIF, where you said it's we could always take one constituent out,
Yep,
like the U.S. banks, for example, and put the REIT one in. I think that's what we discussed. So I guess this is the same type of thing, which is good. I mean, it's always good to have that flexibility. So
correct. Yeah.
perfect. So, all right. So this is more for my newer members that are joining the community. It's a very
Mhm.
common question I get. I mean, I have more all the time. I have Canadian newer members that they've had a financial advisor for 10 years, 20 years. They've
Mhm.
with mutual funds, and now they're taking their investments into their own hands to save on fees and get better returns. So one of the questions I keep
Mhm.
getting all the time, and I never really pondered this question, but maybe you could. I'm sure you get it all the time. Is that you know, uh, Harvest is, compared to a BMO or a Vanguard, a
Mhm,
smaller ETF provider,
mhm,
lesser known, although you're getting more and more popular, and I hope I have something to do with that. But a common question I get from more newbies is, how trustworthy is Harvest or Harvest ETFs? What if something goes wrong with a company, they need to shut down, they go bankrupt? What happens to the investors' money if they're invested in Harvest ETFs, for example?
mhm. Well, that's a very good question. It's a very logical question. And actually, we did used to get that question a lot more a few years ago. We get it a lot less now, though it still comes up. Just a few things about Harvest. I mean, we are a private company, but we are basically through 2.5 billion now in assets. Um, I mean, I can tell you, we carry zero debt on our books. We're in very good shape financially. We're profitable. So Harvest as an organization is very strong. And at 2.5 billion, I think that places us 14th now in Canada for size in the space. Now that said, every ETF, regardless of Harvest, any firm, is an investment trust. So it's actually a separate entity that we set up, but we have a management contract with that ETF. So what happens is, if something happened to Harvest, even if we got taken over or we went under or whatever, the ETF still remains separate entities with their own assets. So either they would be sold to the new company in the case of a takeover, or if somebody bought us out because we were having trouble, or possibly they would be taken over by the regulator and they would find a buyer if that were a real dire case. But they are separate entities, whether that's Harvest or BMO or Dynamic or whoever it may be. We all have the same setup, so they are separate entities, separate trusts that we manage.
Yeah, and
Hopefully that answers your question.
yeah, it does, and there's a lot of laws. The more and more I speak with fund managers like yourself, the more I learn about the very strict laws that protect
Yeah.
investors. It's not like, another fund manager told me, it's even if we wanted to steal our clients' money, we can't, because it's an escrow, and it's, like you said, a
Yes.
complete separate entity. So what I usually tell people is, the scams and the more, the people will steal their money. It's usually financial advisor when there's a middleman,
Hmm.
right? When you're actually signing papers, you're not investing it. You're authorizing someone to invest on your behalf. So I tell people, be careful for that. This is why I always say, invest it yourself, do it yourself investing. So yeah,
Yeah. Well,
that was a
you're right. Part of, and the other thing is, sorry to
yeah,
interrupt you, but I mean, the funds are actually not even held by Harvest. They're held with the custodian. In our case, it's State Street. So they're
that's
even
what I
held
was told.
off
Yeah.
site from Harvest.
Yeah, that's exactly what I was told. So even if you wanted to, you can't. And I've also, was told that, in case, fund managers could actually buy other ETFs from other fund managers to
Hmm.
manage them themselves. So it's not like you're not going to lose your money. Basically, it's not going to go
Correct.
to zero or anything like that. Perfect. So last question I have is that, first of all, congrats on this. Harvest ETFs won a very prestigious award, from the Wealth Professional Awards
Right.
2022, best ETF provider. I'm assuming that's the top award, kind of like best picture
Yeah.
at the Oscars. So I saw the photos and everything. Looked like a nice big gala and ball. I would love to be invited to that one day
Yeah.
somehow. By the way, but congrats on that. So tell me a bit about this the Wealth Professional Awards, because I personally haven't heard of it. I didn't even know there was any awards. So tell me a little bit about it.
Well, first of all, you're right. We were named ETF Provider of the Year, and it was an honor to us and our organization because we've been plugging away at this for a number of years, even before we were an ETF company. So it was nice to get that recognition in the industry and amongst great colleagues, because there were other great managers involved that were nominated as well. Um, Wealth Professional is the industry. I was going to say the industry rag, but it's the sort of industry publication that's used for advisors, for custodians, for investment managers, basically the overall industry. They provide their sort of services and updates on the what's going on in the industry. So they have quite a following. So that's why when they go and they run these awards, they're sort of putting it out there and polling all their constituents, if you will, all of their clients and people that get their magazine, and sort of collect that information, and then they sort of put their awards together from that. There's a number of them. There's about a dozen or so awards, but obviously that was the important one to us, and it was great that we sort of got in there this year and were actually nominated. But it is, I guess, about 10 years that publication's been running now.
Oh,
Well
okay.
Professional.
Okay, well, congrats. I think it's well deserved. I mean, I saw the runner ups. It's all fund managers that
Yeah.
I recognize. So
Mhm.
Harvest has some really really cool income solutions, which is, my platform's bread and butter. So
Mhm.
HDIF, really, really cool. Now you have a Canadian one, HLIF, which we talked about in the lineup. So I hope you guys come out with more and more funds. And if you do, just like in this case, let me know about it in advance, because anything income oriented, I want to know about it and I need to share it with my community. So Michael, it's been a pleasure having you on. Thanks for answering the questions on HLIF, and I hope you guys have continued success, and we'll talk soon.
Well, thank you very much. And again, thank you for having us on. All the
Perfect.
best, Adrian.
Thanks for watching, everyone. Really appreciate it. Make sure to hit that like button, that thumbs up button. It helps the channel grow, so it's a win-win. Also, make sure to subscribe if you're not already subscribed, not to miss out on my future content. It's all about income-focused investing. And also, you got to be subscribed if you want to participate in my surveys, where I ask the audience, I ask you what topic you want me to cover next. So very important. Subscribe, hit that little bell button so you are notified of any new videos and any new surveys as well. Make sure to check out our website. We have a website, passiveincomeinvesting.ca. That's where you could purchase my digital product that I'm very proud of, the ultimate DIY investing package, which is on version 3 right now. So this is a reference tool. It's a companion tool to help you build your own custom portfolio. It's good for Canadian investors and American investors, so it covers both the Canadian and American stock markets. It has sample portfolios as well, multiple sample portfolios for different investing styles. So it's a very cool product, and it does come with lifetime updates. So you only have to purchase it once. My intention is to come out with a new version every single year. So you purchase it once, you never have to pay for it ever again. You'll get the lifetime, the updates for free forever. Also, right there on my homepage on the website, I do offer a one-on-one coaching session. If ever you want a little more personalized help, it's a 1-hour Zoom call with yours truly, a one-on-one with me, where you could ask me anything you want. We'll go through your situation and I'll give you my opinion on how best, I'll help you best I can, basically based on my opinions. Just keep in mind that I am not a licensed or registered financial advisor or financial planner. We also have a Facebook group, so join us there. Passive Income Investing, over 11,000 members. We try to get the spams and the scammers out of there as quickly as possible. So it's a very, very clean group. Everyone's asking questions, trying to help each other, and it's a really, really cool and fun community. If you want a little bit more personalized stuff on our day-to-day life, follow us on Instagram as well. We recently moved to Panama, so if you want some more information on more personal stuff, you could follow us on Instagram. My mission, the mission of this channel, will always remain the same, everyone. It's to help everyday, regular, normal, working people to invest on their own, do-it-yourself investing, right, in order to build their own stream of passive income to enhance their quality of life and one day become financially free, financially independent. Very important goal. So, as usual, I continue to stay safe, everyone. Stay healthy, and of course, stay passive. See you next time.